Most people believe successful investing is about timing, buying at the perfect moment or selling before a crash. But even the best investors in history don't try to time the market. They focus on something far more reliable: consistency. If you've watched my previous videos, you already know this channel isn't about hype, shortcuts, or predictions. It's about understanding how wealth is actually built slowly, patiently, and over decades. Most people don't fail at investing because they choose bad investments. They fail because they hesitate, overthink, or react emotionally to noise. And in this video, I want to explain why consistency beats timing, how the best long-term investors actually think, and why focusing on timing is one of the most expensive mistakes new investors make. And in a moment, I'll show you a simple example where waiting for the right time cost investors years of progress. Market timing doesn't fail because people are careless or uninformed. It fails because people are smart enough to believe they can outthink uncertainty. Timing feels intelligent, it feels active, it feels like you're in control. Waiting for the right moment feels responsible. Doing nothing while markets move feels reckless. Consistency, on the other hand, feels passive. It feels boring, and it requires accepting something uncomfortable that you don't actually know what the market will do next. Timing is appealing because it promises certainty. Consistency works because it accepts uncertainty. And that difference matters more than most people realize. What market timing really is. Market timing sounds reasonable. I'll invest when things feel safer. I'll wait for the next dip. I'll sell before things get worse. The problem is that markets don't move on logic. They move on expectations, fear, and surprises. Timing requires being right twice: when to get out and when to get back in. Miss either one, and long-term results suffer. What's interesting is that even people who get the first decision right selling before a decline still fail most of the time. And the reason surprises almost everyone. Here's the simplest way to think about investing. Timing is trying to be smart. Consistency is trying to be inevitable. Timing depends on prediction. Consistency depends on process. One requires you to be right. The other requires you to stay invested long enough for compounding to work. That distinction alone explains why outcomes are so different. And this is where the conversation changes, because the most successful investors in history follow this exact logic. Consistency doesn't feel impressive early on. In the first few years, it feels slow. You're contributing regularly, but progress is barely noticeable. In the middle years, it feels repetitive. You're doing the same thing again and again while other people chase excitement or react to news. And much later than most people expect, it suddenly looks obvious. People look back and say, "You got lucky," or "You must have timed it perfectly." But what they don't see are the years when nothing exciting happened, the years where consistency felt unrewarding. Those are the years most people quit. Warren Buffett, widely considered the greatest investor of all time, has said many times, "We don't try to predict the market. We focus on time in the market." Buffett does not predict recessions, trade frequently, and react to headlines. He invests consistently and holds for decades. But notice something important. Buffett didn't win because he was faster than everyone else. He won because he was more patient. In fact, Buffett has said that most investors would outperform professionals simply by investing consistently in low-cost index funds. That tells you something profound. The biggest edge in investing isn't intelligence. It's discipline. Historical market data shows something most people underestimate. Missing just a handful of the market's best days can dramatically reduce long-term returns. Here's the catch. Many of the best days happen shortly after the worst days. So when people sell during fear, they often miss the recovery. What makes this even more dangerous is that most investors don't realize this mistake until years later, when the opportunity cost has already compounded. Markets reward participation, not prediction. Let me simplify this with a story. Imagine two investors. The first waits for the right moment. They follow the news, hesitate during uncertainty, and feel smart avoiding risk. The second invests the same amount every month, regardless of headlines. One is constantly deciding. The other is consistent. Same market, same opportunities, very different behavior. Over decades, one compounds quietly. The other second guesses. That difference alone explains most long-term investing results. The real problem with timing isn't that you're always wrong. It's that you only need to be wrong once or twice to permanently fall behind. Miss the recovery after a downturn. Wait too long for confirmation. Sit out while uncertainty feels uncomfortable. And suddenly, years of compounding disappear. Consistency is resilient. Timing is fragile. Over long periods, Fragile strategies don't fail dramatically, they fail quietly, through missed opportunities that compound in the background. John Bogle, the founder of Vanguard, built his entire philosophy around one core belief: you cannot control markets, but you can control behavior, costs, and discipline. Bogle believed the greatest enemy of the investor wasn't the market, it was the investor themselves. Again, notice the pattern. Not speed, not prediction, consistency. Peter Lynch, who managed Fidelity's Magellan Fund, once said, "Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves." Even investors who beat the market warned against trying to time it. That agreement across generations of great investors matters. This is why the agreement between Munger, Buffett, Lynch, and Bogle matters. They didn't share the same strategies. They didn't invest in the same way. They didn't even agree on how to pick investments. But they all arrived at the same conclusion. They focused on staying invested. They focused on discipline. They focused on removing unnecessary decisions. They weren't trying to be clever. They were trying to make success inevitable. That's the pattern worth paying attention to. At this point, something should be clear. The investors who succeeded over decades didn't do it by being faster or smarter. They did it by thinking long-term and behaving consistently when it mattered most. If this way of thinking about investing resonates with you, then this channel is probably for you. I don't focus on predictions, trends, or shortcuts. I focus on long-term thinking, simple systems, and the behavior that actually builds wealth over time. If that's what you're looking for, you can subscribe. I post with that mindset consistently. Now, there's one concern that usually comes up at this point. Some people hear this and think, but what about market crashes? Crashes are uncomfortable, but they're normal. Long-term investing assumes volatility. It doesn't fear it. Consistency doesn't mean ignoring reality. It means acknowledging uncertainty and staying disciplined anyway. Selling during panic rarely protects wealth. More often, it delays it. If consistency works so well, why don't more people do it? Because fear feels urgent, news is emotional, losses hurt more than gains feel good. Timing feels smart, consistency feels boring, but investing isn't about feeling smart. It's about building wealth reliably. There's a simple rule that captures everything we've talked about so far. Never make long-term investment decisions during short-term emotional states. Not during panic, not during euphoria, not because of headlines. Emotions are temporary, but the decisions made during them can affect decades of results. Long-term investors don't eliminate emotion. They design systems that prevent emotion from making decisions. Consistency is built through automatic investing, long-term perspective, and minimal interference. The goal isn't perfection, it's persistence. Quick disclaimer. This video is for educational purposes only. I'm not here to tell you exactly what to buy. I'm here to help you think clearly about investing over decades. Investing involves risk, including the potential loss of principal. Always consider your personal situation and consult a qualified professional if needed. Consistency doesn't look impressive in the short term. It often feels slow and uneventful. But over time, it becomes powerful. And eventually, unstoppable. Most people don't fail because they lack information. They fail because they panic, overreact, or quit during discomfort. And that's exactly what we'll talk about next. In the next video, I'll break down how long-term investors stay calm when markets drop, headlines turn negative, and emotions push people into bad decisions. Because early on, emotional control matters more than returns. If you can master that skill, investing becomes dramatically easier over time. I'll see you in the next one.